All right, welcome everybody to Midas Investing Live for our third weekly discussion. Give me 1 second, kind of trying to switch some of the settings around here. There we go. All right, the stream settings being a little bit weird with me, but all right, here we are at the end of the week. I have in front of us again the S&P and the Nasdaq. I once again pulled up the Nasdaq because it is still beating my portfolio, but overall, market's still having another really good week. Obviously, with the announcement from Jerome Powell with the rate hike, you could have had expectations of maybe the market taking a little bit of a dive, but not so much. Also, we had obviously the earnings that came out this week. A lot of companies reporting, especially some of the larger of the US mega caps. As I kind of put in the title, a lot of the FAANG stocks reported. We had already had the Netflix earnings from last week, but we got the numbers from Meta as well as Amazon and Google. Meta being obviously the big winner of the week, and definitely the winner of my portfolio for the week as well. Before getting into everything a little bit too much, I will say if you missed the video that I put out this week, I did put my Netflix valuation video out, and you know it's heretical for people to say to leave your stream, but if you haven't watched this video, I would actually say leave the stream right now, go watch that valuation, just as long as you promise to, of course, like it, and preferably watch it all the way through. That'd be great too. And if you didn't watch the Acuity one, which was the week before that, that'd be recommended as well. Before discussing too much other stuff, Nuke, gonna have to watch the replay on this one. Have fun. Yeah, catch you another time, maybe in a different time slot. Related to that, also I did put 2 polls up on the channel this week. One asking what, or really this one came almost a week ago, but another one that I put out yesterday as well, asking what the best time to be streaming is. Obviously here we are streaming again on Friday, and you can see that that got the second most votes so far, but technically the poll's still out there. So anybody who watches this hasn't voted on that, I would suggest go voting on that. I'm going to be trying to maybe rework my schedule a little bit around the results of these polls as best as I can. But this one is asking about what day is the best time for streaming, as well as I have another poll asking about what time is best. So far, the winning slot is 6 to 8 p.m. Eastern, which we're currently in the slot a little bit before that. But like I said, we may or may not be switching things around at some point in the future. I was streaming in this slot last week, but then we had less viewers compared to the week prior. We'll see what happens this week. So either way, that's the content that I kind of put out this week. We had that valuation video as well as those polls, so I would definitely recommend people check those out. So as I kind of said, you know, kind of mentioning that my portfolio is continuing to do well this week relative to the overall market being the S&P. If you compare it to the Nasdaq, it is not maybe doing quite as well. What was it? The Nasdaq's up so far 15.6% so far this year. I think my portfolio is just over 13% or something like that at this point in the year. So not quite catching up with the Nasdaq, but still doing better than the S&P, which is what we generally like to look at. This is what the portfolio currently looks like. There's definitely been some general movements in terms of the size of the slices, not because I've put a lot of money into the positions that much over the last few months, but a lot of companies have rebounded drastically over the last few months. So slices that were much smaller have become much larger again, reinflated, so to speak, such as like Sandfire Resources and Inter4 Forestry and Meta platforms. These definitely have reinflated when all 3 of them were definitely much smaller slices due to the fact that they had depreciated in price pretty significantly compared to our original cost basis. I do have the cost basis pie up here, so you can kind of compare between the two. You can see, like, for example, those 3 slices between the 2 pies aren't really that different in size, whereas there's other ones you can still see a drastic difference between, like, for example, Corsair. I'm definitely still significantly down on Corsair. Other interesting changes to note here in the portfolio isn't really about the makeup of the portfolio, but more of just the organization of it. I did have FNG, which is the small green slice here, the smallest company position that I own as an individual value investment. I had it attached to the FNF pie previously because it was a spin-off from FNF, and I didn't have an actual full valuation for the company yet. I do now actually have a full valuation for the company. I don't have a video on it, obviously, but I do have a full valuation, so I separated it and actually am considering it as its own position now, and it's up to 1% of the portfolio. Also, with my new spreadsheet templates that I've been using for my DCFs and will be using moving forward, I have been revaluing all the companies in my portfolio Those have definitely had the highest priority in terms of trying to think about what companies I wanted to fill out my dashboard with. Obviously, I've done Netflix and I did Atcore with those are the companies that I did videos on recently. But I have been quickly trying to do all the companies in this portfolio as well, so that I'm not flying blind, so to speak. Because once I start using the new tools, I kind of just want to use the new tools, and then basically just toss out the old tools and not use them as much. That's just kind of how my mind works. So it's like once I have the new dashboard starting to get filled out, I basically am just like, let's get rid of the old watch list. Obviously, I haven't gotten rid of the watch list; it's still right here. But I'm effectively not even really looking at it on a day-to-day basis anymore. Whereas only a few weeks ago, I was looking at it on a day-to-day basis. Now I'm looking at the new dashboard on a day-to-day basis, even though it only has this small group here. Although I think last week we only had like 4 or 5 names here. So you can see how it's already starting to fill up much faster. But the companies that it's being filled up with are, of course, the companies in my current portfolio. But as of today, I have a valuation for all of the companies, all of the main value companies in my portfolio, which is basically from that green slice to this green slice, except for Inter4 Forestry. And that's partially because Inter4 is going to be reporting their numbers here within a week, and then their annual report will be following relatively short after that. So I kind of just didn't want to get ahead of myself, knowing that their annual report was going to be coming out soon. So I was just going to hold off on that. I'm holding off on a couple other companies in terms of getting them fully done, but I basically did like partial valuations just to kind of get a basic grasp of where the value is with the new tools for most of the other companies. But like I said, as more of the 10Ks come out over the next month or two, I'll probably be fine tuning a few more of these valuations. So with that, I'm going to come over to the actual dashboard. You can see there actually has been some changes with it as well. I changed some of the formatting details of how it's set up over here, as well as, like I said, it is filled out a little bit. Obviously, we have some color coding going on. As I was kind of showing with the previous stream, my kind of general rule of thumb that I'm going to be, how I organize it, how I sort the list, is basically by percentile in the value distribution, which is really just an estimate of kind of where my own estimations are of value relative to my own projections for the company. It's in some ways kind of like a confidence measure, but it's a confidence measure of my own estimates, so to speak. But it is highly correlated with how over or undervalued a company is, as you can see here. It's not a perfect one-to-one. There's some mixed matches between the numbers here, but there is a pretty strong correlation between these two. And so I think of it as a kind of like a more risk-adjusted way of thinking about what is the most over or undervalued company in this list. This is meant to replace the value score concept that I was using in my previous watch list, which was an in-house made number that was meant to assess kind of the value opportunity in different ways based off of all the companies in this particular watch list. So I've kind of changed that, and now I'm using the distribution percentile as kind of like similar to that value score. And in certain ways, I use the value score for other purposes too that I'm not going to be using this number for, but in terms of looking at my watch list, that's what I'm going to be using. But either way, as you can see, it is kind of nicely color coded from the highest point up to the lowest point, with it kind of capping towards 10% or 90%. And then we also have color coding for the upside and downside. But I did a few little different things in terms of for the volume metrics and the share statistics. I have it all shaded red for the Farm 52, and I have it basically shading more towards a heavier red color the closer it is to its all-time high. So we can kind of get an idea of like how bubbly the price is, maybe, so to speak. But obviously you can have a different perspective on whether or not that actually is a bad thing or not. So don't take the red as necessarily some ultimate indicator or something like that. And then also I did have this line here, this particular column. Previously I had it set to just show what the current volume today is, but I actually changed it to be now the ratio of today's current volume to the average volume over the last year. Because that's really what I want to know. I want to know is like, what is the volume today like compared to the ratio of the last year, and then that way I can color code as well, so that, like, for example, Meta has 2.4 times the volume today relative to its average volume over the last year, which means it's a lot of volume out there. You probably don't want to be buying Netflix. Maybe if you want to sell Netflix, it might be good, so that kind of gives you a different perspective on that. Maybe short Netflix. Yeah, I mean, it's definitely looking like it's asking for it. I wouldn't necessarily do that because, in my opinion, you don't want to do to short things without a strong catalyst to back you up. I mean, you don't want to long things without a catalyst to back you up, but shorting things without a catalyst, it's like doubly as risky. So I don't necessarily have a specific catalyst for Netflix in mind, in my perspective, that would drive that valuation lower necessarily. They're still a dominant player within their industry. In fact, in my valuation I did for them, go watch that video. I pretty much talked about how strong their competitive position is. And Apple, well, I don't have a new valuation with the new tools yet with Apple, but I mean, in my old watch list, I'm pretty sure Apple wasn't looking super great. But that is a bit outdated of a valuation, so we'll see what it looks like once I eventually get around to it. But Apple's not a super high priority for me right now. I'm definitely going to be working on getting a few other companies in the list first, and it's partially because I know that Apple doesn't release their annual report until midway through the year, actually like 2/3 of the way through the year, 3/4 of the way through the year. So the point is, in my opinion, I can kind of wait till this earnings season's over and then kind of get around to Apple at that point. Yeah, Apple did have some questionable earnings though. I did hear people talking about that, and I pulled up multiple of the FAANG stock earning reports because I did put it in the title of FAANG earnings, but I, funnily enough, didn't actually pull up Apple's. Partially because, like I said, I knew that Apple wasn't really one of the companies that I was going to necessarily be focusing on in the very short term. I might focus on them maybe in like a month or two after earnings season's kind of cleared out. But I was more interested in focusing on, well, Meta, which is one that's already in my portfolio, so obviously I'm going to be focusing on that. But that one reported, but also ones that had reported was Alphabet and Amazon. That was the other of the FAANG companies that I was particularly interested in looking at in the near future. In fact, I wouldn't be surprised if I did videos maybe on them in the near future as well. We'll see on that part. I'll definitely be getting them into the list. But one way or the other, all of the FAANG stocks and other of the major mega caps like Microsoft as well will eventually make it into the list. They're just they might take a little bit of time. Also, it's worth noting, as really, do you like Microsoft? I mean, I like the company Microsoft. I like their products. I think they're a good business, but I don't necessarily think they're a good value. But I don't have a current valuation on them. My previous valuation, I think, had them still a little bit overvalued at their current levels, but that's a pretty outdated valuation at this point. The only of the FAANG stocks that I actually have a current value for today is Meta and Netflix, unfortunately. I meant don't like mistakes. What do you mean, like Microsoft? Because I don't think I don't know about any specific mistakes that they're making per se, but anyway. So also I would say I haven't done quite the deep dive level to say that all these values are super secure. These are kind of tentative values. Is one thing that always put me in other words. Yeah. You kind of got to be careful with the typing, otherwise it can be hard to understand what's said in there. But as I said, I was kind of like rushing through a lot of these valuations, just trying to get them in here so that I kind of have like a ground level understanding of the companies in my portfolio with the new tools, and have an idea of like where I'm going to go with them. But there's a lot of them that I'm going to do a little bit more of a deep dive, go much more deep into the 10K, pick up a lot more details and focus on like industry metrics and comparisons, and try to think about like where I think their actual projections of future revenues can go. So I haven't really done like a revenue deep dive or a cost deep dive on a lot of these companies. So even though it shows some of these as pretty overvalued, Netflix I did do that for. So Netflix is done for. But like Corsair and Buckle, you can see here are a little bit lower, and Fidelity as well. Barrick, I haven't done as solid of deep dives for these, even though it says that these are overvalued here. There's a good chance that I will eventually re-rate them upward as I kind of actually use the tools in a more comprehensive way, because the purpose of having put together the new tools is that you can do a very, very comprehensive set of work, but that kind of takes a larger period of time. F&F negative value, it was your best if I'm remembering well. Yeah, I mean, I'm explaining why right now that you shouldn't pay attention to that value. That's what I was just saying. I'm saying is like when I put the valuation in here, I basically put super conservative estimates in with the new tools. So it is likely the F&F will probably be less valuable than my previous estimates for it, but it's probably not necessarily overvalued as it shows it right here at this moment in time. I'm probably going to revalue it upwards. I've just been putting them in here as quickly as possible. So it's not done, is basically my point. The only companies in here that I have like a really super 100% solid estimate here for is Netflix, Atcore, Intel, and then I would probably say Smith & Wesson as well, because those ones I've spent a little bit more time with the new tools to make sure that the estimates are super accurate. The other ones I just kind of quickly rushed to make sure I got all of the financials in, because I've been trying to fill out this this dashboard with all of the details. And some of them I still have to put like the quarterly information in for, because if you remember, these tools rely on annual information but also quarterly information. But you can see here, for example, there is no information in the quarterlies. I only put the annual information in, so it's half done. It's like it's a bit of a half-baked valuation so far, which is why I still have the previous watch list, which shows the other sets of value. But like I said, it's based off of previous assumptions, and eventually, once these valuations are much more comprehensive and much more complete, I am going to eventually get rid of this dashboard altogether. So it's kind of a work in progress. Anyway, so also over the course of the week, as I kind of been showing over the last few live streams, we're going to be kind of paying attention to this pretty regularly, the model portfolios, which you can check out by joining the Discord and checking out the free Google Drive. The free Google Drive is in this particular link here in the Discord, so you can go and check that out. And also, if you're watching, you haven't already, live or on the replay, please like the stream, subscribe to the channel. Both of those things help attract more viewers to the channel, but also subscribing will make sure you get notifications whenever I go live or whenever I release my valuation videos. But also join the Discord. The link is in the description below. Also the pinned comment in the chat. Join the Discord. That way you can be part of the daily discussions that we have about what's going on in the market, what's going on in our own portfolios. Also, like I said, you can get access to the tools that I give for free, such as the model portfolios, which is based off of the previous dashboard of research. So that is worth noting. It is based off the previous old tools. Once we have the new dashboard fill in with a whole new set of companies, and maybe at like the end of the quarter or maybe halfway point or something, we'll probably refill the model portfolios with the new research, and maybe we'll compare them over time. But either way, the model portfolios on average have performed about 12% so far this year, which means they are also doing better than the S&P, but not as good as the NASDAQ. Not as good as me. It turns out I'm doing a little bit better than the model portfolios as well. But also, as we had kind of discussed with the model portfolios, there is kind of a little bit of a sampling bias kind of inherent within it. So if I attempt to kind of do my best to net out that sampling bias, what's left from that 12% is actually just less than 6% or so this year. So what that means is that the quality of my research from last year, because it's basically based off of the valuations from last year, provided approximately 6% more value so far this year than would be expected if it was just kind of randomly selected. So doing pretty good so far this year as far as that goes, both in terms of my research and my own portfolio for my own performance. So with that, at this point, we can kind of take a few different directions about like what we want to talk about. As I kind of put it in the title, to talk about FAANG earnings. I as I said, I did pull up different presentations from the FAANG earnings, so we can take a look at Meta or Alphabet or Amazon's earnings if people want. Like I said, I didn't pull up in Apple's or Microsoft's. Both of them, because they are putting their annual reports at different points in the year. So I kind of was focusing on Q4 numbers primarily. So if you guys have a preference between Meta or Alphabet or Amazon, we can take a look at those, or we can do neither of those things. We could actually instead just go and take a look at stocks and screen different companies. So it's up to you guys on that one. If nobody has any other particular opinions, then I will actually probably just pull up in the Meta presentation and talk about that until somebody says otherwise. So obviously, people were taking a look at the you can see obviously with the chart, the Meta has performed ridiculously well. They're up almost 30% this week or something like that, and up almost 50% since the start of the year. Obviously over the last couple quarters, it was a huge question. Shorts, what about shorts? What do you mean about that? The huge question over the last quarters was obviously whether or not they were reaching only overvalued. What do you mean? Man, you gotta be more specific with your comments. I'm not sure even what you're saying. Are you telling we should talk about only overvalued companies? What do you mean? What companies should be short? Is that what you're asking? To the hold on, we come down to the users. Yeah, this is the good stuff. So obviously, like I said, the previous in previous quarters, the question was whether or not they were kind of reaching too much of a maturity, especially in the United States, and especially with Facebook in particular. If you come down to like the Facebook daily active users, in the previous quarter, they had gone from 1.968 billion or million daily active users down to 1.984, which is a very, very tiny decrease, but it was a decrease nonetheless. You was asked which stock. I said overvalued stocks. So that's what you want. You want to look at overvalued stocks. Well, which ones? Let's say you gotta because like when I say let's look at stocks, I mean let's like screen for cheap stocks. Like I do have a whole bunch of pre-screening that I've done over here. So we could just look at a whole bunch of tickers. You do want to look at overvalued stocks? Well, I mean, name some. That's what I'm saying. Is like I don't have a list of overvalued stocks for you necessarily. I mean, if we paid attention to my previous list, we could sort of sort based off of that. Netflix or Apple or whatever you want. Netflix. Well, we could take a look at Netflix, but I talked about Netflix last week. Apple. We can talk about Apple. We can take a look at Apple a little bit. Do they have a presentation that we can look at? I hate when companies don't have like a good slide set. I think the bears are waiting for us. Well, if you want to hedge, I mean, hedge, I guess. I don't know what to tell you in terms of that. Yeah, so I don't necessarily have know what specifically to say about Apple because I haven't looked at them yet. So that's kind of part of the problem. It's like I haven't really like looked at their earnings yet. Like I said, I do know that people were upset with the quarterly. So it's like let's take a look at the. I don't know if this particular thing breaks it down into sections or not. Yeah, so they just have this like basic release. It'd be nice if they had like a Yeah, so for the 3 months ending in December, they had a decline in products from 104 billion on the quarter to 96 billion. That's a pretty significant decline. That's the products, so iPhone sales and other devices. Whereas services still had a little bit of growth on it. Not quite a billion or so. So that's like what, 4 or 5% or something in services growth. Looks like services cost of sales increased at a higher rate. I have to see that in percentage terms, but it looks like the gross margins in services came down a little bit, if I had to guess. And then cost of sales, that's down 4 billion versus the 8 or so in that. So that looks like, yeah, gross margins, it looks like probably came down as well in both categories. So that's definitely not super good, but kind of what you would expect given moving into recessionary concerns. They still increased their research and development costs, which is good. You definitely don't really want to see that much of a slowdown in research and development costs if like until worse comes to worse. SG&A costs, this definitely ticked up, but at a much slower rate, so that's good. It would be better if they had cut costs in that terms of that, because that's going to bring the operating margins even lower, nonetheless. But at least it's not growing at a faster clip. Yeah, I don't know. Like I said, it's like I haven't looked at the specific category types And I'm not sure if they actually have that in this 10K or not, or 10K, 10Q. Let me see if I can find it real quick. Oh, they had the information by country. Let's see about that. So in the Americas, they lost a couple billion. This is the quarterly on the quarter. Versus Europe, that's a little bit more. So that's a couple billion in Europe, but they're in the 20s billions versus 40s and 50 billion. So in percentage terms, Europe lost a higher percentage. China, Greater China, which includes Taiwan. Really hate that they call that Greater China. That looks like it also dropped in greater percentage terms comparative to the Americas. Japan, that also looks like it is in higher percentage terms as well. Rest of Asia Pacific, that one doesn't look quite as bad in percentage terms because that's only 300 compared to 9 billion. So I think that's a relatively small percentage amount. It's like I don't actually have the percentages in front of me, so I'm just kind of like trying to think about that in my head real quick, what that would be in percentage terms. But so it's like if you kind of think about that, America is the strong geography out of all weak. They're all weak, you know. They dropped in basically all geographies. But America appears to be the stronger of the pack, which isn't entirely surprising. I mean, the rest of the world is definitely dealing with lots of issues in terms of that. Like I said, I would really kind of like need to find the net sales by category. Here we go. Oh, hey, look, percentages. How nice of them to actually put percentages here. At this point, it would have been nice if they'd done that for some of the other spots too. But yeah, so down 8% in iPhones on the quarter. This is from the previous fourth quarter to this fourth quarter, which, you know, thinking about fourth quarters, I didn't say that in terms of thinking about the geographies, but the fourth quarter is going to be super important quarter for them, obviously, because it's the Christmas quarter. So there's going to be it isn't actually the fourth quarter. Oh, my bad. It's not their fourth quarter. It's like everybody else's fourth quarter. My bad. I'm getting this wrong. It's actually like their second quarter, if I'm not mistaken, but whatever. The last quarter of the year. that's what I meant. It's the last quarter of the year. It's everybody else's fourth quarter. It's Apple's like second quarter or whatever. But anyway, like I said, 8% down in iPhone. That's pretty bad considering it's like the biggest component. You know, you can see 70 billion versus 123 billion. So it's like it's more than half of all of the total sales by category. Obviously, the biggest drop being in Mac. Which makes sense because that's definitely going to be a little bit more of a discretionary purchase. You're going to purchase iPhones every year, every other year, maybe every third year. Macs is going to be more like every 3 to 5 to 7 to 10 years, you know, something like that. iPod, that actually had significant iPod. Aging myself here. iPad had a 30% growth. That's actually pretty interesting to see, considering that is also a discretionary product. So it's pretty interesting to see how that's going on. I wonder if they have some interesting discounts going on into the holiday season there, maybe, or something like that. I don't know. I haven't paid super close attention to the releases of them, so maybe they had some new tech in the iPads that kind of explains that or something like that. Wearables also down 8%, so that's more what I would have expected. In fact, I would have expected iPad to be down probably more like in teens or something like that personally. So that's kind of actually somewhat of a positive note to see, that strong iPad growth. Let's see. Product sales include amortization deferred value. Yeah, that's nothing super important there. Yeah, so, you know, I mean, it's bad, but it could be worse. I mean, down 8% in iPhone category, that's the bad. In many ways, that's worse than down 29% for the Mac, just because it makes up a much larger section of their business. And obviously, it's more indicative of also major economic concerns for other companies as well, because of all the suppliers and down chain companies from Apple as well. So, I mean, yeah, you know, Apple, it definitely looks like they're going into a little bit of a downturn. I don't necessarily know how much that's going to push into future quarters. They might be able to bounce back by the fourth quarter of this year, but I would expect further weakness for the next quarter or two. If we're seeing down 8% in the fourth quarter, then it wouldn't shock me if we see, again, comparing quarter to quarter. So comparing to first quarter of last year, I don't know what the numbers looked like for first quarter last year. That's why I kind of hopped back over here real quick. So yeah, it's like if I'm looking at this, you can see in last year they had 124 billion in total revenues in the December quarter, and then in the March ending quarter they had 97 billion. So this is
maybe indicative of somewhat normal seasonality. I don't know if that's entirely what normal seasonality looks like for them. 26 billion, 27 billion downward into the first quarter. So that means you would maybe, if you saw a similar number, or if we think about that maybe in percentage terms, that would be like, that's about a fifth. So if we see maybe a fifth drop in revenue from here, which we have 90 billion revenue for this, well, this is the wrong quarter here, my bad. I didn't realize that Yahoo didn't have the information there. 117 billion, you have 117 billion in this particular quarter, well, then that means we might expect a little bit lower even than this 97 billion, maybe 90 billion, maybe 85 to 90 billion. So that would maybe be an expectation for the next quarter of that. I'm actually curious. Let's hop over to the analysis. If they have, do they have a quarterly estimate? Oh, this one here. Yeah, let's hop over to. So I mean, just thinking about how expensive they are, because you're talking about, you know, overvalued stocks. That's what how we got on this Apple conversation in the first place. Where's the annual? Hold on. $30% overvalued. Is that what I had them at? Did you scope it out? Yeah, that's what I have on this estimate right here. But I mean, I don't really remember exactly what estimates I had going into this either. Like I said, this is an old valuation, so it definitely might need readjustments. Okay, so I had implied 2023. Back over to the analysis. Yeah, so my estimates were not terribly far off, I guess, in terms of revenue for 2023. My estimates were actually a little bit rosy for them in terms of estimates for 2023. My revenue estimates were a little bit higher for them. What did I do for margins though? So that's another question. I probably was pushing their margins back down. I have margins coming back down to 23% over the long run with that estimate. So yeah, I mean, 29%, like I said, it's using certain capital assumptions that I'm discarding those spreadsheet tools for a reason. I'm choosing to move on to the different tools I'm using now because I think they add a much more comprehensive set of value. So I mean, maybe not 30%, maybe that's a little bit of an overestimation, maybe it's 20% or something, but it could be 30%. That's my point. Definitely overvalued. I mean, like I said, let's come over to the share statistics. If we're just thinking about trailing P, it's at 22, 23. I mean, how much do you expect to grow from it? That's the thing. It's like, if I'm thinking about a hardware company, because that's what Apple is they're primarily a hardware company. You know, we can talk about their services, but their services make up only about a fifth of the business, you know? And the question is like, if you're going to say, oh, well, they're going to be a company with software margins in perpetuity forever, well, then that means that they had better get these services revenues to like more than half of the business. Are they going to do that? I mean, maybe they will, but I don't necessarily think that that's going to happen because the services are based around their products, right? So you're going to always have this kind of like base level of the amount of products you're selling, and then the services kind of come on top of that. The people are buying the product as more of a needs-based product, and then the services become much more of a discretionary thing to me. So the point is a 23 PE is only justifiable under security kind of circumstances, under considering a guaranteed cash flow. If you consider Apple a super guaranteed brand that's literally just not going to go anywhere for the next 40 years, well, then you can start to justify that PE under that sort of reasoning, that even under a slow growth rate over a long enough period of time, it will grow into it. But that's the bet you're taking, is that you're going to have this company that's not going to grow that fast, is going to just kind of grow into that. The other alternative is that you're expecting higher growth. And like I said, I personally don't find that to be super viable personally. But that you know, the different people have different perspectives on. Oh, here we go. Finally got to the gross margin where they're going to do a comparison into percentages. Yeah, so comparing on that. So yeah, we did get the gross margins coming down in both categories. I was right on that. Products, it went from 38% down to 37%, whereas services went from 72% down to about 71%. So, you know, I mean, the services are still very, very profitable, but the point is and they still managed to get a little bit of growth, as we kind of talked about. So that's nice for them that the services managed to grow, but they didn't grow that much. That's the thing. It's like, if we think about it in just a gross profit kind of terms, they went up about 600 off of 14. That's about half of as much of that. That's, what is that, 3 to 4%, maybe 4 or 5% if I'm estimating wrong. So they managed to eke out a little bit of gross profit growth in terms of services, comparative to the like 4 billion, 4.5 billion or so shrink in for the products. So that's good, but either way, the percentage terms still came down, which that's gonna leak into future lower profitability over time, which really kind of backs up the estimates that I had in the previous valuation of with having those margins come back down over time. So yeah, I mean, I like I said, this valuation's old at this point, so I'm not saying it's a super accurate valuation. It's based off of their last year numbers projected forward, really. But I think this is probably not super far off from reality. I'm thinking that they're 25% overvalued. I think that's pretty reasonable to assume. But that also depends on what cost of capital you're using for those for your estimates. So that's which is always a factor. And like I said, I will eventually get around to doing a more proper new valuation of them at some point. But in the meantime, yeah, that base estimate's, I guess, all I got for that. So I will say, if you're watching live or on the replay, if you haven't already, please like the stream. Please like the stream. Is the best way you can pay me for the entertainment that I'm providing. Subscribe to the channel also if you haven't already. That way you get notifications whenever I go live, or whenever I put other videos out, like my Netflix valuation. If you haven't seen my Netflix valuation, go check out my Netflix valuation. You have my permission to abandon this stream as long as you watch that Netflix valuation and like it. Also, if you've done both of those things, the pinned comment in the chat, also in the description below, is the link to the Discord. You can join the Discord, be part of the daily discussions that we have going on there of what's going on in the market, our portfolios, as well as access to the free Google Drive link that exists there as well. So go check out that stuff there. So you know, having looked at that stuff, we looked at Apple. I don't necessarily have too much more to say about Apple. If anybody has any other specific company that they would like me to take a look at, we can take a look at that, or maybe I'll start diving into some of those companies on the pre-screening list that I had, and maybe talk about that a little bit. So I have, as I was saying, these kind of like lists of pre-screen stocks that I've done, different sets of screens that I've done over the last few weeks in the background as I've kind of been working on all these valuations. I'm a big fan of TIKR Terminal. I'm not sponsored by them in any like official sense, but in a certain sense, I kind of like provide free advertising for them in a sense. Like Adani. I mean, I don't really have much to say about Adani because I don't really know anything about it. It sounds like it's a pretty horrible mess to and all that, but I haven't looked into it and I haven't read the Hindenburg report, so I'm not sure what necessarily to say about Adani. But it looks like a big mess. I haven't looked at it, like I said, but Hindenburg does some pretty good research sometimes, and I'm not the type of person that thinks all shorts are evil or anything. I'm actually a big fan of short sellers in a certain sense. But anyway, so I have I'm a big fan of TIKR Terminal. We need big mass companies. What do you mean big mass companies? I'm a big fan of TIKR Terminal. They have a really good screener on here. I use their one of the levels of their premium subscription because it allows for extra financial reports looking into the past, up to 10 years of their financials, but also extra screening tools, which I'm a pretty big fan of. But anyway, so I have this kind of set of screens that I've been kind of playing with in different ways in here. This particular new screen that I kind of recently put together is this one up here, which I screen based off of price to book ratio. but it's not screening out a certain amount of price to book ratio. It's actually screening any company that basically has a negative price to book ratio, because I'm just trying to get rid of companies that have negative book value, effectively speaking. So we're not actually punishing companies that are trading at high price to book. It's effectively just screening out companies with negative book value. But that I do screen out any company that has a current ratio of less than 1.25, frauds companies to short them. Yeah, no, I mean, that's definitely stuff to do, but like I said, I don't necessarily have anything specific to say on that subject. Current ratios of 1.25, return on invested capital of greater than 10%. The thing when it comes to return on invested capital, when you're looking at like a screener like this, is that like it all comes down to how did they calculate these metrics. So like they're going to calculate the metrics maybe in a different way than I calculate the metrics. So I often kind of have to maybe use a slightly more conservative or more forgiving number in the screen, given what I think is going on in their calculation. So I'm going to assume that when they calculate return on invested capital, they probably include a larger amount of things as capital than I do, because a lot of people don't subtract out cash and securities from their capital when calculating that number. It kind of depends on who's calculating it from what. So the point is even though I typically don't actually like necessarily thinking about companies with returns on invested capital less than maybe like 12 to 15%, or something, I'm willing to maybe put 10% in the screen, because I'm going to assume that their capital base is probably larger, and that's going to make the numbers lower. Then I also have total liabilities as a percent of total assets, less than 75%. That's actually a pretty heavy amount of liabilities percent of assets. A lot of people don't like to have that much assets relative to liabilities, but this isn't meant to be like a super hardcore screen. It's really just meant to screen out the worst of the worst. We're not really trying to like get down to a list of a small amount of companies. We're actually trying to get a pretty broad list of companies that we can then play with a little bit more ourselves. So returns on invested capital greater than 10, total liabilities as a percentage of assets less than 75%, EBIT ratio to interest expense. This is similar to the metric that I use for calculating default risk, and I'm just saying greater than 5. I just want to get rid of companies that have a pretty significant default risk due to their interest expense. Asset turnover less than or equal to 2. Now, asset turnover is sales relative to your assets, and so basically it's saying like how many years of your sales do you require in order to purchase all of your assets. If you think about this, this is actually a reverse of the sales to capital ratio that I use for capital efficiency. So we're basically looking for companies that have a ratio of less than 2, which basically means that they have a sales to capital ratio of greater than 0.5. If you think about those things as reversed from each other. Then I also have total revenues for the last 5 years and total revenues for the last 10 years, a CAGR of greater than 1. I want it on both those intervals to basically show that it's companies that are at least regularly growing a little bit over the long run. You know, they don't have to be growing a lot. They just need to not be shrinking, effectively speaking. Even, this is less than inflation. So technically in real terms, they would be shrinking, but at least in nominal terms, not shrinking. And then I have industry displayed, because that's one of the things that we're going to use for narrowing the list down a little bit further. I also have gross margin displayed because gross margins are so heavily tied to the industry. So these are the metrics that we're going to, like I said, do things with ourselves. We're not screening out companies based on that. We just want to know what the numbers are. So we're just displaying it. I'm doing the same with the cash conversion cycle. Plenty of companies don't even have inventories or receivables anyway, so not all companies have a full cash conversion cycle that you can calculate. So it's another one we're just doing for display. It depends on the industry we're looking at. And then I did the same thing. I did a variety of forward estimates that are provided by TIKR Terminal, which is one of the cool things that they have in their screen tools, is that you can screen based off of forward estimates as well, which is pretty neat. But anyway, they have a revenue for the next forward year, the median estimate for revenue. I'm just displaying these numbers. I just want to know what they are, because that's the point, is like if I include this information, we can look at companies where there is some actual analysis out there. Like a lot of the companies, when I look at TIKR Terminal, a lot of them are small, obscure companies. If I do this, then it allows me to focus in on companies where at least there's some analysis out there that I can maybe see what some other people are looking at and saying in terms of future projections. So I'm not going entirely blind. Of course, that is a crutch. So, you got to be careful when you're choosing to rely on things like that, because it is a crutch. You got to make sure you're thinking about it that way and think critically about it, and not just rely on some random estimate somebody has out there. But the point is, it gives us at least somewhere to start in terms of thinking about some of these industries. But anyway, I have the revenue estimates for the next 2 years. I have the EBIT estimate for the next year, and then I also have the management guidance for the next year, if that's provided as well. Because TIKR Terminal provides those metrics as screenable options. Anyway, so the point is I screened based off of all these metrics in the United States. It's basically only companies in the United States, and it got me 148 companies. 148 companies. So you see what, like I was saying, it's like we didn't screen super hard in some of these categories. We were pretty just bare minimum. We just wanted to get rid of bad companies. We weren't really trying to find good companies. We're just trying to get rid of the bad companies. Because then we'll look at the list ourselves and we'll identify the good companies after we narrow in on some specifics. But we want to get rid of companies that are just kind of generically bad. Now look at this. TIKR Terminal has access to 67,000 companies to screen. 67,000 companies, and with all those metrics, we ended up with 148 companies. 148 in the United States. That 67,000 is global, it's worth noting. So really in the US, it's like a third or half as much of that or whatever. But whatever, the point is 148 companies. And it gives us the statistics based off of all those metrics we had there. Well, though we can look at that however we want, or we don't have to think about that either. But the point is it gets this huge list. Like I said, it's a huge list, 148 companies, so it's a little bit unwieldy. I did actually pull it over into a spreadsheet because TIKR Terminal allows you to copy and paste all that stuff as well. So I mean, I have that list here, and what I did is that here, let me actually shrink this down a little bit. I wanted it to zoom in a little, but maybe not that much. What I did is I sorted it by industry. Now, because that's what I was kind of showing you before, is that a lot of these metrics, it depends on what industry you're in, how much this is going to matter for certain things. Start just some shit stocks in the screener, and be careful with the cursing. The chat thing sometimes does some automatic filtering when people do that. It can be a little bit weird that way. But anyway, so if you filter, if you sort all the long list that we ended up with and sort it by industry, we end up with a pretty wide variety of industries. Now the real question is, this is a question for you guys. I mean, which industry would you guys like to look at? We ought to choose one and kind of like pay attention to it. We have aerospace and defense, auto components, building products, capital markets, commercial services, electrical equipment, healthcare equipment, household durables, IT services, machinery, metals and mining, semiconductor equipment, specialty retail, shoes, textiles, and apparel. Yeah, so you can see is like we can narrow in on specific industries, and that can kind of give us a better idea of like what we want to look at. I don't know, maybe I'll choose electrical equipment, instruments, and components. So it's like if I just kind of narrow in on here. Actually, I can just do a sort. Actually, can't I? Filter by value. Oh, it filtered it out, didn't it? My bad. Oh, that's got electrical equipment. And instruments. Okay. There we go. So we got electrical equipment, instruments, and components. So just by doing that, we narrowed our 138 companies down to a much more manageable 11 companies or so. Sorry for the silence there as we did it. And then based off of that, then we can start to actually look at some of the specific metrics and maybe actually sort based off of those metrics now that we've like focused in on a specific industry. And that's where, like I was saying before, like something like gross margins, that starts to become a little bit more relevant, because gross margins is definitely much more of an industry specific thing. So if we're looking at electrical equipment as an industry, you may notice that ATCOR is already up here, which is one of those companies we looked at kind of recently. Well, then maybe let's take a look at some of these other companies like AYI or Keys. Now, one thing that's worth noting is that all the stuff that we filtered in here, right? Like when I did this screen, you may notice that there's basically nothing in this list has to do with valuation. The price to book ratio is in here, but as I said, I didn't filter it based off of like a certain value. I just filtered it based off of companies that had a negative book value because I wanted to get rid of it. But I didn't make an order based off of valuation or anything like that. So even though we currently sorted it based off of gross profit, so these are the most profitable companies, but these aren't the cheapest companies. The cheapest companies in this grouping right here appear to be this company E Plus or Sanmina Corporation, or technically there's this one right here of zero, but I'm gonna guess that there's something weird going on with that. That doesn't sound right. So that's kind of my point, is that it doesn't necessarily mean that these are cheap companies. We were focusing more on qualitative metrics, more on operational metrics, and trying to think about it that way, because that's the thing, is I was trying to filter out bad companies, not thinking about what's cheap. We're just filtering out bad companies. So like, I don't know, let's take a look at AYI. Name sounds kind of familiar, so I feel like maybe I've looked at them a little bit before, but I don't really remember anything. So obviously, yeah, industrial electrical equipment and parts. From our description, provides lighting and building management solutions in North America and internationally. Oh, I think I've seen them as like as a competitor for some other companies. I think I might have seen them listed in the competitors that Atcor listed or something like that. Company operates through two segments: Acuity Brands lighting and lighting controls, and Intelligent Spaces groups. ABL segment provides commercial architectural and specialty lighting solutions, as well as lighting controls and components for various indoor and outdoor applications. Okay, so a whole bunch of lighting products. That's pretty interesting stuff. It might depend on the specific technology being used, what type of competitive advantage they may or may not have. They're based in Atlanta, so at least that gives them, the geographic nearby advantage for local companies in the United States, for like home builders. This is electrical equipment and parts. It's lighting products. A lot of that's going to be going into buildings, so you got to think about like who their customers are going to be for. How good of a competitive position does it give them? We think about what is the forward projections for them. We did have some of that information in this list already, as I was kind of saying. If we kind of come over, according to TIKR Terminal, next year it's expected 4.2 billion, 4.3 billion in the year after that. It's expected maybe about 600 billion in operating profit in the next year or so. So 4.2 billion, 600 billion operating profit. If we compare that maybe to what they have in here on Yahoo, the average for this year. Okay, so TIKR Terminal has a little bit of higher numbers in terms of the revenue estimates. Yahoo doesn't have the EBIT numbers, but if we come over to financials, like how does that compare to what they had previously? Operating income in the trailing 12 months was at 510. So according to the analysts on TIKR Terminal, they're going to have more operating profit next year than they've had over the trailing 12 months or in the past 3 years prior to that. I don't necessarily know how accurate that's going to be. We could have included a filter to include the number of analysts. They do actually have that, and I didn't include that. So that might have been useful, because who knows, maybe this is just one random guy's estimate. But based off of just that alone, this company could theoretically be more profitable next year than they are this last year. 2023 compared to 2022. Who knows? Maybe those are wrong estimates, as we said, but maybe they have good estimates. Maybe they have a large backlog that's well covered. We can look at some other things. 42%. Again, kind of thinking about that. What does their net income look like compared to that operating profit? Operating profit of 510 million versus 371. So yeah, I mean, they got some interest expense, presumably, maybe some other non-operating expenses going on there. Over time, if we kind of compare the two, it doesn't look like they're losing a massive amount of their operating income. So most of that operating income still makes it to the bottom line. That looks pretty good. Compare cash flows. Their operating cash flows look really good compared to their operating income, but that's not going to take into account the reinvestment levels. But reinvestment levels, at least over these last few years, don't look super extreme, other than in 2020, we had this 359 million in investing cash flows. That's interesting. Did they do an acquisition, $300 million acquisition of some sort? I don't know what it was, but okay, that explains why they had a really large investing cash flow. So that kind of explains that. It could be good, could be good, it could be bad too, but it could be good. Free cash flows look pretty solid. The free cash flow estimate for this year is not going to include that acquisition, so we should actually assume that this is more like 150 million for this year. But even so, if that's 150 million for that 1 year and it's because of an acquisition, then overall these free cash flows look pretty good compared to the operating incomes. Coming over to the balance sheet, some of the things that we had in the details here that we were filtering on, as I kind of had talked about, was the interest coverage ratio, which isn't directly related to the balance sheet. It's related to the income statement, but it's related to how much debt you have. So if we kind of thinking about that, what was their interest coverage? They had an interest coverage of 18. That means they should have no problem with their debt, I would assume. Liabilities as a percentage of assets, 44, 45%. Returns on invested capital up to 20%. Even if we assume that their earnings are going to get cut in half over the next 5 years because they're part of like a somewhat building related industry, that would still bring their returns on invested capital down to 10% or something like that. And like I said, I think TIKR Terminal tends to lowball returns on invested capital comparative to how I calculate it. So that could still look pretty good. Depends on what their cost of capital ends up looking like or something like that. Over the last 5 to 10 years, they've had solid revenue growth. As I said, I was just trying to make sure companies weren't shrinking, so I'm not really thinking about how great that is necessarily. Their asset turnover, they can turn over their assets in a little over 1 year. That's pretty capital efficient. It's not super capital efficient, but it's pretty capital efficient, especially if you've got decent profit margins. So I mean, look at that. Just right off the bat there, that looks pretty good. Acuity Brands looks like a maybe interesting company to look at. Now, everything I just said there, everything I said about Acuity Brands had nothing to do with price. You may notice that. Nothing to do with price. We didn't even look at its price. I mean, it's right there, but I didn't look at the chart. I didn't really think anything about the price. I didn't look at the ratios. I did open this page now, so now I'm kind of already starting to do so. But up to that point, we didn't say a word about price. We just talked about the company. We just talked about what they did, what industry they're in, who they might be selling to, what the numbers look like maybe for next year, as well as what their current financials look like. Now, after we've done all of that, we can start to maybe think about price a little bit. As we kind of already said, yeah, $191. If we look at the trailing P, they're at a P of 15. That's, in today's environment with today's interest rate setup and stuff, that's not super cheap, but that's maybe cheap. That's the ratio where it's like, well, it depends on what your growth profile is going to look like. It depends on what your profitability profile looks like, but it's maybe cheap. What does it look like compared to the past? See, if they're trading at a 15 now, but they've been trading at single digit ratios in the past, then that's a warning sign. But that's not what we see here. We see teens for the last few quarters. So that looks pretty good. I mean, that's only 1 year. It's not a whole lot of information for the last few ratios or so. I don't know how expensive they were in the last few years prior to that, but maybe they're not so bad. And again, we have estimates of growth for them. That's the other thing we have to keep in mind. Again, we have estimates of growth. Those estimates could be wrong, but they are estimates of growth. Coming down to share statistics, it looks like they're shorted a little bit, a little under 5% as a percentage of float. That's not a major amount, but it's some shorting is starting to go on there. It's not very well held by insiders. That's not super great, but it's not necessarily a bad thing. They have a dividend. It's a relatively small dividend in terms of yield, but small in terms of yield means it's also small in terms of payout ratio, So that means it's a secure dividend, almost certainly. It would be shocking if it wasn't secure, considering it's a 5% payout ratio. They'd have to have some weird stuff going on with their cash flows for that to be a problem. So, hey, there's at least a secure dividend. It's less than 1%, so it's practically non-existent, but they're probably going to grow it over time. It's probably new. I haven't looked. I don't know that for sure, but based off of its yield, I'm going to assume it's a pretty new dividend. And so that means that it probably has high dividend growth rate going forward, assuming that's true. Again, that's a pretty bold assumption. Looking at their just basic balance sheet information, 281 million or 284 million in cash compared to 574 million in debt. So, they could pay off more than half their debt right now. That's pretty good. And then remember, when we were thinking about operating incomes and stuff, we were seeing maybe 500 to 600 of EBIT next year or something like that. So that if that's the case, then they could theoretically pay down all of their debt by the end of next year if they wanted to. Doesn't mean they're going to. They probably isn't even advisable that they do so. But the point is it shows that there isn't really a whole lot of risk necessarily with their debt. So just based off of all that, Acuity Brands is already looking like a pretty interesting company, but at least take a look at. I don't know too much about it. Maybe there's some stuff about what's going on with their specific products or business lines that I don't know, or their customers. But if we take a look at the last year, okay, they're actually pretty flat for the last year. Lots of ups and downs in the interim. Not necessarily crazy in percentage wise as ups and downs, but ups and downs. Last 5 years, they definitely had drop in 2020 and then a little bit of a bull run as they probably got large amounts of business. But it's pretty interesting to see that as we moved into 2022, they really didn't get punished all that much. You can see that they didn't really get punished all that much, whereas they had maybe a little bit of a starting punishment from their peaks of over 200 coming down here into the summer, but then they've kind of slowly edged up. It's kind of flat-ish, but slightly up flat. You know, it kind of depends on the current point of the curve, but that could be based off of the fact that, as we were already said a couple of times, they're expected to grow. Again, these estimates could be super wrong, but who knows? I also did mention their cash conversion cycle, as it kind of has it listed here, is down at 59 days. If people are not familiar with the concept of the cash conversion cycle, it basically combines together basically the amount that it takes for you to pay off your payables, as well as the time it takes for you to receive your receivables, as well as the amount of time as it takes for you to burn through your inventory. And it kind of takes all three of those numbers and boils them down together into one number that is numbered in terms of days, that basically gives you an estimate of how much time is it, but on average, between when you book a profit and when the cash comes into your building. It's not a literal amount of days, because like I said, it's an estimate based off of adding together three different averages. But it's a number people use to kind of think about capital and cash efficiency for a company. And like I said, it's also a very industry specific number. So that's kind of why I wanted to only focus on that once we got down to the industry specific. But if we're thinking about it compared to the other companies we have in our list here, now these companies are probably going to be somewhat divergent from each other. We did narrow in on one specific industry a bit, but even in this, electrical equipment and electrical instruments, that's pretty diverse. That can still be pretty diverse in terms of how companies can operate there. So even so, we got to take it with a grain of salt. But the 58.93 is the lowest number on this list. So this looks like one of the most capital efficient companies on the list. It looks like one of the most cash efficient companies on the list. And it doesn't even look like it's super expensive, especially comparative to the potential growth for it. So I just right there, I don't know how long that took. I think that was like 20 minutes or something that we just did, just looking at that one quick little list. I just did one quick little screen right there. As I said, I had kind of already started with the results that I had here, and then I just did a few estimates there. And the part that I did here, I did not do before stream. So I literally just kind of came up with that decision on the fly. And then we just found one company just like that. Like I said, who knows how cheap it actually is if you were to value it. There's no guarantee that I'm going to value it. So just because we found this company here today, don't think that it's the next company that's coming out or something, the next value video I'm going to do. But the point is, who knows? Maybe I will look at it. I'm probably going to be looking at the electrical industry a little bit more closely, because I've been somewhat curious about that industry, as well as like other building product industries as well. It's part of the reason I valued Acuity. I was somewhat interested in this industry a little bit already. So Acuity Brands, we might have to take a look at that at some point in the future. Unless anybody has specific tickers or something that they want me to maybe take a look at, or specific questions about portfolio management or my own portfolio or things like that, then we might start to wind down the stream a little bit. We got to over the hour point, so unless somebody has some specifics, that might start to bring it to a close. Trying to think if there was any other happenings I didn't mention. I didn't mention it when I brought up my portfolio pie, but I did actually get out of position this week. I did exit out of Jeffries. Jeffries was one of my smallest positions. It was only like 2 to 3% of my portfolio or something like that, and we exited out of that position today. BB, do you take swing trades? Yes and no. I don't take swing trades defined as a swing trade. I don't take an investment specifically with the idea that it's really just going to be for a specific time frame. I value companies kind of with always the same perspective, but I am willing to exit a company at any time based off of my own perspective of it. So so effectively speaking, I do end up doing things like swing trades, but it's not really like I go into it with that mentality. Technically, you mean you never took? Yeah, since like I don't really like to think about it as swing trades. Like I don't visualize or conceptualize my moves as something like, oh, this is a swing trade and this one's not a swing trade. Everything I go into, I consider it as, what do I think the value is? What is the time frame based off of that? And then I go into it. Oh, you mean technicals, based on technicals? I don't really look too much at technical analysis. I pay attention to it a little bit here and there, but I haven't really devoted a whole lot of time trying to understand it. One thing I have shown is that, for example, here in my new dashboard, I'm trying to include a lot more information related to like moving averages for the companies. So that's at least a little bit of some basic technical information that I try to pay attention to. I am trying to think a little bit more about like whether or not companies are on a momentum run when I'm selling them or when I'm buying them and stuff like that, or whether or not they've turned the corner in terms of their downturn. So I'm trying to think a little bit about technical analysis at the margins, but not really a lot. That's the thing, is like I don't make investing decisions based off of technical analysis. I'm never going to look at a company and say, oh well, it really looks like the technical signal has come, it's going to turn the corner, and now I'm going to buy. I only buy a company that I think is undervalued, or I think has a specific cash driven value proposition to it. But if I can convince myself to not sell this week and instead maybe sell next week or maybe sell the week after that because of a technical signal, maybe I'll do that. Maybe I'll do that. Or same thing about buying. It's like if I'm already want to buy a company and I'm already going to buy it and I'm already buying it, I might choose to buy a little bit more this week because the technical signal indicates maybe it's a good sign too. But like I said, I don't actually do that much analysis of it myself, other than paying attention to moving averages a little bit here and there, or paying attention to what the current volume is here. I don't really calculate specific technical indicators myself, but some of the members of our Discord community do that stuff a little bit here and there. And so I definitely do pay attention to when some of those guys are posting their charts here in the Discord. So you should join the Discord for some of that information, maybe, if you're interested. And you can ask them to give their perspective too. You could ask them what they think about the charts of a specific company, and maybe they'll provide that information. So I like to think of technical analysis as kind of like seasoning. Maybe it's like adding salt to a meal or something like that. Yeah, I mean, I know you are, bro. I'm saying it for everybody else who might listen at some point. Don't worry, I know. But yeah, I know you're in the Discord. Like I said, like everybody else who might listen, I wanted to make sure that they know that exists. But yeah, so technical analysis is maybe a tool to use a little bit at the margins, but for the most part, I just focus on screening companies and finding value propositions. That's kind of my thing. My thing is really just looking at financials and building DCFs for the most part. Technical analysis is like adding a little bit of extra seasoning to the perspective or something like that. So with that, I think that'll bring the stream basically to a close. Looks like my man BB is basically the only one basically show up. I appreciate all of your participation though. At least I had you here to converse with for the most part. Everybody who watches live on the replay, as I've said already several times, please like and subscribe to the channel. It'd be really, really appreciated. Please go check out that Netflix valuation video that I put out. It's super high quality. I think I did a really good job on it. I'm really, really proud of it. Also, we will have another valuation video, not this upcoming week, but the week after that. I haven't decided for sure what company it's going to be, but I think there's a good chance it's going to be Meta that I do the next video on. So that's probably, I think, what it's going to be, but it's not for sure. We'll see. Maybe over the week, maybe my opinion will change on that. But in a week and a half or so, that's when that'll be coming out. But I will catch you all on the next live discussion stream next week. As I said, there is those polls out there about the timing and the days of the streams. I haven't made any changes about that, but it's possible that the time of this stream will change. Maybe to the Sunday as people were wanting it, or maybe to a different time frame. But I'll catch you all again next week. All right, bye.